with the Division 2 of Schedule 3 of the Companies Amendment Act 2015 in last session. So we completed the part 1. So in part 1, what we learn, that is we learn the we can say the different requirements pushed by the Companies Amendment Act 2015 for the we can say for the balance sheets and the changes in the equity statements. Okay, so we see how the formats of the balance sheets which mandated by the Companies Amendment Act 2015. Um, Actually, what is the structure? So we see that the two main components of the balance sheet, that is the assets and liabilities. So asset must be on the we can say is on the upper side, and the liabilities is on the lower sides of the balance sheets. And then we classify the assets into the two types, that is the current assets and non-current assets. We also classify the liabilities into the equities, current liabilities, and non-current liabilities. Okay. We also see we can say the mm, changes in the equity statement. There are different types of equities, that is we can say the share capital, that is the equity capital, reserve, surplus. So all these must be clearly and realistically should be mentioned in the financial statements. Okay, and so we also learn that the disclosure of the financial statements is very important from the point of view of the stakeholders. If the bias information is present in the financial statements, okay, so the stakeholder is not able to take the good decisions. Okay, in the morning session in the security analysis and portfolio management, we also learn that the any investor before going for the investment in the any organization, he has to refer the financial information of that organizations for the of the company. Okay, so how he refers the financial information? He refers the different financial statements. So also we also learn that the we can see the unbiased information, the realistic information is very important. That is that disclosure of the information realistically is very important from the business view. We can say from the point of view of the different stakeholders. That is the investors, we can say the creditors, management, and all this. So in this, in the last sessions, we see the two financial statement, that is the balance sheets and the equity. We can say the statements of changes in equity. So in this session, we are going to understand what are the requirements which are mandated by the Companies Amendment Act 2015 to disclose the, we can say, in the preparation of the statement of the profit and loss account. That is what we call as the income statements. And second one is the notes to financial statements. Okay, so we can see the different notes we are putting. We can say for the understanding of the who reads the financial statements. Uh, so what are the we can say the what are the mandatory things which mandated by the Companies Amendment Act 2050 that we are going to discuss in these sessions. So the statement of the profit and loss account, the what we understand from that statement is very important. That the profit and loss account statement or income statements tells me the income position of the company, income position of the organization. That means the company is in a profit or the company is in a loss. Okay, so here we are going to know by analyzing or by we can say by preparing the profit and loss account. Okay, so if the information we can say what the uh, government or the act wants, they want the realistic numbers in the profit and loss account. So what are the different rules and regulations provided by that we are going to understand in these sessions. Okay, so what What is there is in the, we can say, in the Schedule 3 and Division 2 of the Companies Amendment 2015. So the Schedule 3 prescribe the format and disclosure requirement for the financial statements under the Companies Act of 2013, that we understand that is the Schedule 3 is contained with the different disclosure, different rules regulations for the can say different financial statements. The Division 2 also applies, we can say, specifically to companies complying with the Indian standards. So those Indian companies, we can say all the companies who are working in India who follows the norms of the Indian accounting standards, for those companies, the Companies Amendment Act provides certain disclosures. The 2015 amendment introduced the key changes to enhance the, we can say, the transparency and the comparativity. In the last sessions, we also see that is the this law provides the transparent mechanisms, and they wants the comparability of the same organizations over a period of time or with the some other organizations. Okay. So next one is why Division 2 matters. Why that changes is very much important from the Indian company's point of view. We can say to align with the global standard. First point is the global standard. So the we can say Indian corporate financial reporting must we can say align with the global standards, and then only we can compare their financial parameters. Next one is we can say the enhance we can say disclosures. So what government wants? Governments wants to ensure the detailed classification and disclosure in the profit and loss accounts and notes. Okay, if there is any incomplete information disclosed by the companies, if there is any notes missing in the financial statement, then who reads the financial statement, he may be confused, or he not able to understand the complete meaning of the financial statements. So that's why the government, or the we can say the Companies Act Amendment Act wants the complete disclosure of the financial information. Now next one is we can say the stakeholder support. Okay, to support the different stakeholders for their decisions based on the financial information. Okay, to provide that financial information. So that's why government this division 2 matters a lot because these financial information support the investor, regulator, stakeholders with the clear financial information, financial insights for the better decision making. Okay. So that's why the Division 2 of the Companies Amendment Act 2015 matters a lot to as the students of the finance to us also. Okay, so we must have the in-depth knowledge of the Division 2. So whenever in future so you may work as the financial manager in the any of the organizations. So whenever you are going to prepare the profit and loss account, okay, or we can say the balance sheet, or the we can say changes in the equity or the cash flow statement, at that point of time you must keep these things in mind. Okay, so do not forget any notes, important notes in the financial statements. Now next point we can say we first we overview this statement of profit and loss account or the income statement. Okay. I think you already learn that statement in your first semester in the subject of managerial accounting. That is the, we can say, we called it as the profit and loss account. Okay, you also analyzed this statement in your last semester subject in the financial management, in which you prepare the comparative profit and loss account. That means for the same organizations, you compare the, we can say, revenue, profit, or the different components of the revenue and the different components of the expenses for, we can say, for the 2 different years or for a overall period of time. That means we compare the financial parameters of the same company for 2 different years that you already learned. On that basis, what I consider you are aware of what is the profit and loss account and how the profit and loss account prepared. Okay, so we can say the statement of profit and loss account is the crucial financial document that provides the comprehensive, not incomplete information, but we can say it is a comprehensive, we can say that provide the comprehensive information. That means a complete information to the different stakeholders. They provide the comprehensive view of a company operational performance during the specific year. Okay, that means the profit and loss account provide the complete financial information for that particular year. Also, the uh, profit and loss account presents the company's financial performance over the reporting period. Includes the what profit and loss account includes? It that includes the revenue. How much revenue the company is generating for that specific time period. If you consider any financial year, if you consider the financial year 24-25, how much they revenue they generated, how much sales of the goods and services were done by the organizations, how much expenses they incur to produce that goods and services, how much profit they raise. Okay, if they bear the losses, then how much losses they bear. So all that things were present in a profit and loss account. So the division 2 mandates the minimum line of items and additional disclosures while the preparation of the profit and loss account. So that we are going to understand what is mandated by the division 2 of Companies Amendment Act 2015. Now, first we can say this is the format of the profit and loss account. You guys know the income statement. For first, we write the year in the upper side. Okay, at the start of the any, we know the company name, we know the financial year. For which financial year we are going to produce. So first point is the we can say the revenue. Okay, so we can say the company may generate the revenue from the two or more different sources. Their main source of revenue is the whatever the goods or services they are producing and selling into the market. They may also have the other income as well. If they are having the some we can say the other businesses also, or if they rent their property, they earn the interest on the funds. So these are their other incomes. So in the revenue, what you find that is the gross sales. Okay, how much the company sales for that particular year? It is the main income source of the organization. Now, if they are having the other incomes that we also put here, we can say below the gross sales. Okay, so we will get the total sales. Now, if the company sells something and they get the return, so we minus because uh, this return we not consider as the income, so we'll get the net sales. Okay, so so the net sales is the total revenue raised by the organizations. But while raising that revenue, that company has to produce the goods and services, and then they sell it into the market. But while the production, they require the cost. Okay, so here the next point is the cost of goods sold. Okay, so in cost of goods sold, we can say inserting the different cost. That is the beginning inventory. So the purchases, okay, direct labor, indirect expenses, okay, all these that we got the cost of goods sold. If you minus the net sales, uh, we minus the net sales minus the cost of goods sold, what we got? We got the gross profit. That means whenever we minus the revenue minus expenses or minus cost, what we get is the profit. But this is the gross profit, not a net profit. That means after that also we are having some expenses. Okay, so expenses on we can say the advertising expenses, okay, marketing expenses. We are having some bank charges, bad debt. Okay, so some charitable contributions. Okay, payment to the contract laborers. Okay, the delivery expenses. So all these expenses, if you we can say minus these expenses, Okay, then we will get the we can say the we get the net profit. Okay, and this is we can say the format of the profit and loss account. Okay, so what are the different disclosures which are mandated by the Division 2 of the Companies Amendment Act 2015 that we understand first. Now we see the some of the major components of the profit and loss account, that is the revenues, cost of goods sold. We can say the other expense. We can say the expenses. And then we get the gross profit. Okay, uh, uh, then we get the we can say the net profit. Okay, we can say then also we get the operating profit, and then finally we get after paying the taxes and the interest, then we get the net profit. So revenue is the we can say one of the most important components of the profit and loss account. So the revenue components, what the requirements which mandated by the Division 2 of the Companies Amendment Act, that is the revenue from the operations of the net of returns, discounts, other incomes, that is the interest, dividend, gains, etc. That means the company generating the revenue through the different sources, and that must be disclosed in the revenue section. That is mandated by the Division 2 of the Companies Amendment Act. That means the company, we can say, uh, don't have the permission to hide their incomes. Okay, we can say we can say to avoid the tax. If the company is doing that, then it is the crime. It is the tax evasion. Okay, so the all the revenues, okay, must be disclosed by the company or the organizations. Okay, and they must have to classify the revenue into the different parts. That is the revenue from the sales. We can say the revenue from the other incomes in the form of interest, dividends, gains. Okay, so they'll have to disclose all these things. Now, next one is we can say the expense categories. So the companies have to disclose all the expenses that they incurred. That is the cost of a material, employee salaries, okay, financial costs. We can say the depreciation of the machineries. So all these things the companies must have to disclose in the profit and loss account. Now, next part is the profit measurement. Okay, after we can say. Uh, if we minus the expenses from the revenues and then we get the profit. So how the profit measurement must be done while the preparation of the profit and loss account? That some of the things which are mandated by the Companies Amendment Act. That is the profit before the exceptional items and tax. That is the profit for a period. That means first we'll have to calculate the gross profit, then operating profit, and then after deduction of the tax and interest, then we'll calculate the net profit. Now the net profit is the taxable income of the organizations. Okay, so gross profit is not the taxable income. Okay, okay. After the gross profit, also the companies have some expenses, advertising expenses, marketing expenses. Okay, but after deducting that expenses, the companies get the operating income, and operating income after paying the interest. Okay, after paying the interest on a loan, then the company remains with the in profit. That profit we call as the net profit. Now the net profit is the taxable income on which the if the your company the company has to pay the taxes to the government as per their income slabs. Okay, in which income slabs they are we can say uh, are coming. According to this, they have to pay the taxes to the governments. Now, next one is we can say uh, because of the Companies Amendment Act 2015 or the Division 2 that enhance the we can say the disclosures requirements. That is the Division 2 significantly expand the disclosure requirement to provide the stakeholders with the more granular financial information. That means the division two, we can say significantly, we can say give the uh, companies, we can say the instructions to disclose their financial information so that different stakeholders can refer that financial information. Okay. Now, next one is this enhanced disclose information. That means this extra financial information which are getting to the different stakeholders that enhance the you can say the understandability of the different stakeholders, and also they helps to understand the company's financial performance in a greater detail, okay, with the more context than the previously required. Okay, so whenever the we can say informed financial information is available to the stakeholder, he is his understandability increases. He easily understand that financial documents. Okay. Now, next one we can say why the notes to the financial statements are important. Okay, so as we see, the some of the different financial statements, that is the balance sheets, uh, cash flow statements, income statement, profit and loss account statement, or we can see the changes in the equity statements. So if the note is missing, if some of the important notes are missing from where we get that funds, okay, if, if we sell the goods and services on the credit basis, how much amount we receive in a cash, and how much amount, how much the credit sales we sells on a credit. If, for example, if we sell something, we can see the 50 lakhs amount goods and services, we can say goods to any of the customers. For example, 50 lakh sales we done to the customers. The customers pays the 20 lakh rupees to us. Now the 30 lakh rupees is pending with the customer. So that's called as, we called it as the credit sale. If the note is missing in the financial statements, then it is a, we can say, a big blunder. If you only put in the financial statement that we sell 50 lakh 50 lakh rupees goods, then that means that you receive the 50 lakhs on the same time. If you miss the credit sales note in the financial statement, so that means the notes are very much important from the point of view of the understandability of the different stakeholders. If the notes are missing, then the we can say the readers are is in a confused stage. He is not. He is having the half information. Uh, he may be a he may have the misguided information. Okay, so on that basis he will take the wrong financial decisions. Okay, so the notes to the financial statements are, we can say, these are very important from the point of view of the readers, from the point of view of the who refers the financial statements to take the different we can say decision based on that financial informations which is available to him. Okay. So here are some we can say some of the we can say by doing some research, the researchers has give some percentages for the notes, that is the 60% additional context of the financial statements. Users rely primarily on the notes for understanding the complex transactions. Okay, if the we can say the 60%, that means from the financial statements the readers understands only the 40%. Okay, he understand only the 40% we can say financial information, but if the notes are missing, then he do not understand the other part. So the notes increases the 60%, we can say the those data which are we care say the 60% additional context of the financial statements who helps the reader to understand the financial statement. So the notes are very important part of the financial statement. Now the 3x more details. That means the efficiency of the financial statements get increases when the notes are present in the financial statement. That means notes typically contain the three times more information than the uh, primary financial statement. That means they provide the three times more information to the readers, more information than the financial statements. Okay, now next is 100% compliance. Without putting the notes, we say the financial statements are incomplete one, or we can say the half one. So it is not the complete statement. So notes in the financial statements of the different financial transactions uh, are, we can say, a very important part of any financial statement. So the notes, we can say, the complete notes are essential for full regulatory compliance, and then only we called it as the complete financial information. The 100% compliance were fulfilled when the detailed notes are present in the financial statements. Okay, so financial statements provide the narrative explanation and the detailed breakdown beyond the we can say the profit and loss account figures. Okay, that notes provide the details information. So how the what is the exact position of these financial transactions. Okay, the financial transactions done or not, it is pending or it is, we can say, half pay half pending. Okay, what is the time of the payment? Okay, what is the time of the credit, 2 months, 6 months? So these notes provide the detailed information who reads that financial statement, that financial information. Next one is the disclose the financial statements disclose accounting policies. We can say the contingencies, commitment, and the related party uh, transactions. Okay, so all these things are, we can say, detailing were present in the notes only. Okay, uh, so on that basis, these notes clarify the items not recognized in the we can say profit and loss account or the income statement, but they're relevant for the user's understanding. Okay, so we can say the notes we can say clarify those items which are not present in the financial statements, whose marking is not present in the financial statement, but it is essential for understanding financial informations. Okay, so the readers get the clarity. He clarify his doubt. If the readers has the any doubts in his mind, then by reading the notes in the financial statements, he clarify all the doubts he has in his mind. Okay, which are the notes which are mandated by the Division 2 of the Companies Amendment Act 2015. Okay, now first one is as we that is the equity reserve. Okay, now these notes are essential in the all types of the financial statements. Okay, uh, from the point of view of the balance sheet, from the point of view of the income statement, from the point of view of the cash flow statement, and from the point of view of the changes in the equity statements. Okay, so in all these four statements, the note must be there. Okay, so which are the notes which should be mandated by the Companies Amendment Act 2015? So first one is the equity reserve. So as we all aware that the equity and the reserve are the part of the balance sheets. Okay, in balance sheet, we know that is in the liability side, we put the equities. Okay, so what the Companies Amendment Act 2015 mandated that the equities and should be classified in the we can say in the different classifications. Like we can say the equities we can classify into the equity share capital, in the preference share capital. We can say the different reserve. Okay, okay, so which type of nature or or we can say if the company raise the we can say the share premium, okay, so they will have the reserve. So all these things should be clearly mentioned in the equity side. Okay, so what uh, the Division 2 of the Companies Amendment Act wants, they want the clear note, that is the clear classification of all the equities. Okay, so if the any accountants or the financial expert only write that is the this is the amount of the equity, but he forget to put the note of his classification, then who reads that financial information he is incapable to understand, okay, how much the reserve of the organizations, okay, how much their equity share capital, how much their preference shares capital, okay, how much they raise the funds through the share premiums. Okay, so this information is we can say the incomplete informations if the notes of such classifications are not present in the financial statements. Okay, now next one is we can say the trade receivables and loan. Okay, so the classifications into the secured and the unsecured loans. Okay, good and the credit impaired, or we can say this classification must be there in the notes and to understand the different classification of the we can say the trade receivables and the loans. Okay, so or we can say for the MSME disclosure, the disclosure of principal and interest, that is the unpaid loan, small medium enterprises. Okay, so all these loans should be there to understand the uh, we can say the complete financial informations of the any of the companies. Okay, now there's some of the times that is the Division 2 of the Companies Amendment Act 2015, they want the presentation and a rounding of the figures. If the company is having the we can say the figures more than the 100 crores. Okay, so the figures may be rounded to the nearest hundreds, thousands, lakhs, or the millions to avoid the we can say the complexity or the we can say the complicated information, so which are we can say the unreadable. That means if I say there are the 7 to 8 numbers, so so on the we can say on behalf of the 8 to 10 numbers of the revenue, I can write the 100 CR, okay, or the 1000 CR. Okay, so it is not the exact that the company is earning the 1000 CR exactly. It may be the 1000 CR, or we can say 1000 CR 56 lakhs 986 rupees. So whatever it may be. What the Companies Amendment Act or the Division 2 want, they want to we can say the rounding of the figures. That is the figure may be the rounded off to the nearest hundred thousands, lakhs, and millions. So uh, we can say it is allowed by the Division 2 of the Companies Amendment Act. Okay, so next one is we can say why this disclosure we can say is important because of the comparative figures and the consistency. Okay, so why comparison matters to any of the company, any of the organizations. Okay, So the comparative figures are immediately preceding period must be presented. Okay, we can say if the same format is followed by each and every organizations in any specific company, so they can we can say they can compare the figures very easily. Okay, and they can immediately preceding and they can easily presented that figures. Okay, they can take actions easily. Okay, if they found that the one company is doing great, other company is not doing well, so what is the reasons? They can find it out the reasons, inside reasons, outside reasons. Okay, what are the different environmental factors? So all these things they can analyze, and on that basis they can we can say take the certain decisions. Okay, we can say they also the financial statement facilitate the trends analysis and performance evaluations. Okay, so on that basis, if the complete financial information is available with any of the stakeholders, okay, so he can find it what are the trends. Okay, if we have the balance sheet, then we can find it out what is the trends in the assets of the organizations. Okay, how the assets of the organization change for the for certain period of time. Okay, for trend analysis, we must have to take the minimum 7 year time period. Okay, so above 7 years, we can take the 10 years, 15 years, 50 years, 100 years. So, okay, it depends upon the we can see the information available to you or not. If the information for last 100 years is available of any older company, so you can take that company and you can analyze that from last 100 years how the we can say the equity of that organization is increased. Okay, how the liability of the organization is increased, how the profit of or the revenue of the certain organizations from last 100 year increase. Okay, so we can analyze the trends. Okay, so we can analyze the trends of such a company which are very new. For example, the Apple is doing Apple is not a very older company, but now it's the number one company in the world. Okay, so how we can see the development of the Apple is we can say is the example to the other companies. Okay, so they can analyze their financial informations, how they we can say boost such a huge development. So all these things can be done with the help of the complete financial information of the organizations. Okay, so we can follow the trends. Okay, we can also analyze the trends in the revenue, the trends in the profit, trends in the losses. So all these trend analysis, okay, with the help of the graphs, we can draw the graphs of the different trends, and then we can interpret their graphs. Okay, such as in your OGT projects, you guys are we can say shows the complete information in the form of graphs. Okay, some of you may find we can say the trends of the last 2 3 years. Okay, so so this is we can analyze by using the complete financial information. So we also can analyze the we can do the performance evaluations. Okay, so based upon as you guys learn the topic that is the we can say the comparative analysis of the different financial statements, you also do the ratio analysis. So in ratio analysis, what do you guys do? You check the performance evaluation of the different companies. You check the financial performance of that organizations. Okay. So based upon the ratios, you conclude some sentences. That means if I calculate the liquidity ratio for any organizations, that means I check the liquidity position of the organization. That means the company is capable to pay its short-term financial obligations or not. That means the company is in the position to repay the short-term loans, the loans which he takes to fulfill his working capital requirement. Then he has the enough liquidity with the organizations to repay that loans or not. Okay, so that we are going to calculate in the liquidity ratio. Same, we calculate the profitability ratio. That is, you guys heard, that is the net gross profit ratio, operating profit ratio, net profit ratio. So these are the ratios we calculate to check the performance of the any organizations. Okay, so based upon that, if the gross profit ratio, operating profit ratio, net profit ratio is showing good indications, then I can conclude that the organizations is doing well. Okay, so this is how we check the performance. We do the performance evaluations. We also check the we can say in liquidity ratio. We check the short-term paying ability. In solvency ratio, we check the we can say the long ability of the organization to pay the long-term loans. Okay, in solvency, we calculate the interest coverage ratio is that means we find it out that the company is able to pay the interest on the loans or not. So that information we check based upon the financial informations. Okay, now also we can say the changes in the presentation. Okay, so we can say the cross referencing between the SPL notes. Okay. Mm, uh, Here is one of the example of the we can say the practical example of the revenue and expense disclosure. That is, we can say the notes enhances the efficiency of the financial statements. Okay, any of the financial statements. Okay, that we can say that cross referring between the profit and loss account and notes what they told to us that connects the line item. Okay, so each line items in the profit and loss account must be cross-refer related to notes. Okay, that means for every financial transactions, okay, which we thinks that it is, we can see it is a complex transaction. So the note should be there for the easy understandability of the readers. Okay, that enhance the traceability. We can easily trace the different financial transactions in the financial statements if the notes is we can say present. Okay, from the notes we easily understand what is we can say the what is the financial informations and where we can get it, so we can easily trace. Okay, and that notes the balance the informations. Okay, so without notes we can say the financial statements are imbalanced statements. These are the incomplete statements. But when we add the note or to that financial statement that balances the details with clarity to avoid the information misguidance, or we can say the information overload. Okay, so so due to this the notes we can say enhances the efficiency of the other financial statement also. So here is the practical we can say example of the revenue and exposure we can say disclosures. So here the organizations disclose the, because here in this example we say that the same organization is producing the four different products, that is the product A, product B, product C, and service C and service D. Okay, so by selling these the different products and different services, the company generating the revenue. Okay, so if the company is only we can say show the total revenue. Okay, so we are not able to understand what the company is generating from profit product A, what the revenue he we can say generate through product B, what the revenue he generate from product C, service C, or what the revenue they generate from service D. Okay, and we also do not know the we can say the expenses for each product. If they we can say put the summation of all the expenses at the same time. Okay, so so here they show we can say the distinct revenues and the distinct expenses for each and every product. Okay, So now I know the product A is giving the highest revenue to the organizations. Okay. Product B is giving the second highest, C third highest, and lowest is the service D. Okay, so this is the type of the note. Okay, which we can say if this note is we can say not in the financial statements, then we can say we don't have that information. Okay, this disclosures we can say some of the example that we take to understand the notes. Okay. Now we can say the what are the exceptional items and the tax expenses. Okay. Which must we can say disclose in the in notes. Okay. The some of the exceptional items disclosed separately to highlight the unusual gains, losses that are material but not recurring in nature. Okay, so these are some of the examples that must be present while your preparation of the financial statement. Some of the exceptional items, that's, for example, that is the restructuring cost, asset impairing charges, litigation settlement, gain and losses on a business d- disclosure. So all these note should be there in the financial statements. And some of the tax expenses are like the we can say the tax expenses split into the some of the different components like the current tax, deferred tax, prior period adjustments. So all these notes explain the nature and impact of these items on a profit. Right? Okay, on a profit or on a loss. Okay, so uh, and they provide the context for the usual fluctuations in the financial performance. Okay, so all these items tells the different stakeholders that what are the we can say the further impact of these different factors. Okay, if we include these factors into the financial information, financial statement, then who reads the information, okay, then he refers this information to take the further financial decisions. Okay, so impact of the amendments of financial statement preparations. Okay, we already know that before the 2015, it is not the case that there is a no preparation of the financial statement. The financial statements were also we can say we prepared before the amendment of the Companies Act 2015. Okay, but after the amendment, what is impact we see? Okay, uh, that we are going to discuss, that is enhance the transparency. So okay, after the we can say the Indian Companies Amendment Act 2015, Division 2 disclosures that enhance the transparency in the financial disclosures. Okay, that increase the we can say the increase the efficiency in the we can see in the financial statements of the companies that we can say has the complete information that enhances the disclosure, that improves the transparency, and on that basis if the realistic informations is there in the financial statements, then the different stakeholders gets the complete information and takes the efficient decisions. Now next one is we can say the global integration. That means before that we can say not follow the same disclosure as which follows on the international levels. Okay, so that we can say that uh, hard to compare the Indian companies with some international companies. Okay, so the global integrations. Uh, so after the amendment of the Indian Companies Act 2015 that aligns the Indian reporting with the global standards. Okay, so then we can compare uh, our financial parameters to the international companies parameters. Now, next one is we can say the dual compliance. Okay, so after that amendment act that helps the companies to comply with the
Indian accounting standards also, and the international standards also. Okay, and we can say the Companies Act, which mandated this. All these things are simultaneously followed by the different companies while the preparation of the financial statements. And after we can say this amendment at 2015, the better analysis we can do on basis of these financial statements. Okay, so that facilitate the better decision making by to the investors, to the analysts through the comparable data. Now we know that there is the uniformity and the consistency in the preparation of the financial statements of the different companies. Okay, so we can easily compare the data. We can easily do the analysis of the data. Okay, and what are the we can say the challenges and the best practices. So what are the common challenges we can say after the we can say the amendment of 2015, that is the balancing details disclosures with the readability, ensuring accuracy and the consistency in classifications, regular updates to comply with the involving regulations and accounting standards. So that I will share with you all these PPDs so you can read it. It is very easy to understand. So all the what are the common challenges and the best practices. Apart from this, in the technical terms, if you have any questions, you can ask me the questions based upon. Uh, okay, before that, we will check that the students is listening the sessions carefully or not. Okay, I call some names. Okay, so you have to unmute yourself and give me your attendance proof. Okay, Suhani Dedgi is present there. Suhani, some of the peoples, I think the Pile Giddy is there. Pramod Kanamuse, Gnanu Shilwanta is there. Okay, guys, so the time is up. If you don't have any questions, you can leave the sessions. Okay, we close here. So here the two chapters of the financial reporting, that is chapter one and the chapter two, that we complete here. Okay, from Monday start the third chapter. Okay, thank you guys. Thank you. You may leave now.